wrote in the newsletter that I thought 3,000 was probably a pretty good price. I mean, we did the math on it, right? And it's like, you get up to like $20 trillion worth of gold. Just for reference, there's like 50 trillion worth of residential real estate or something in the country. There was like 66 trillion worth of stock until recently. Now there's like somewhere in the 50s. So then you start doing the math and you say, well, would 5,000, I mean, would you really, would 8,000, would gold be worth more than stock? Now, if it was, it's like, probably you should really think about that, because there have been some times where gold was worth more than the stock market. You could do the Dow to gold ratio. And in those times, you actually should have bought stock. I mean, that's like, I don't want to say that's going to be the case again, but what I'm trying to say is that $20 trillion is a lot of money.
During economic uncertainty and rising inflation, gold has historically outperformed stocks. In contrast, when the economy grows steadily and inflation is under control, stocks typically deliver better returns than gold. With the likelihood of heightened market uncertainty under a second Trump administration, driven in part by expected increases in U.S. tariffs and retaliatory countermeasures that could fuel inflation, the current environment appears increasingly favorable for gold. Historically, equities have been the dominant asset class. Over the past 70 years, the Dow Jones Industrial Average surged by 13,900%, far outpacing gold's inflation-adjusted rise of 7,800% per ounce over the same period. However, the next 5 years may tell a different story. Persistent geopolitical tensions, central bank accumulation, and ongoing inflationary pressures could give gold the upper hand, potentially pushing prices as high as $5,000 per ounce by 2030. On the other hand, if the global economy enters a stable growth phase with subdued inflation, stocks may once again outperform due to increasing earnings and dividends. EBTucker, author of Why Gold, Why Now, and editor of the Tucker Letter, points out that while there have been rare instances when gold outperformed stocks, as highlighted by the Dow to gold ratio, he isn't forecasting a repeat of those conditions. Nonetheless, with gold holdings globally valued at around $20 trillion, he suggests that $3,000 per ounce is a reasonable and solid level for the metal. Gold prices have recently risen above $3,000 per ounce due to a weaker U.S. dollar and increased trade tensions between the U.S. and China. Demand for gold as a safe haven asset has strengthened, with prices touching $3,150 before retreating. Tucker notes that gold is not a speculative asset. Instead, it serves as a stable store of value and is crucial for long-term wealth preservation in uncertain times. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think 3,000 is a good price. I mean, I wrote in the newsletter that I thought 3,000 was probably a pretty good price. I mean, we did the math on it, right? And it's like, you get up to like $20 trillion worth of gold. Just for reference, there's like 50 trillion worth of residential real estate or something in the country. There was like 66 trillion worth of stock until recently. Now there's like somewhere in the 50s. So you start thinking about $20 trillion worth of gold in the world. It's kind of like a lot of gold. I mean, so then you start doing the math and you say, well, would 5,000, I mean, would you really, would gold be worth more than stock? Now, if it was, it's like, probably you should really think about that, because there have been some times where gold was worth more than the stock market. You could do the Dow to gold ratio. And in those times, you actually should have bought stock. I mean, that's like, I don't want to say that's going to be the case again, but what I'm trying to say is that $20 trillion is a lot of money and it could go higher. But it seems like at this moment, now then the price went to like 31.50 or something. And then people were writing in telling me that I didn't know what I was talking about. Now it's like under 3,000, but maybe it'll come back around 3,000 for a little bit. If you look at the chart of gold, which we occasionally put in the newsletter, it's a beautiful chart. What you see is that it's quite a boring asset. I mean, it's not really something that you buy and you hope to make some huge amount of money. Now, this is a kilo bar, so this is 1,000 grams of gold, and this is a nice thing to buy because it doesn't take up much space. But I think people need to understand that you don't really buy this to like make a bunch of money. What you do is you buy this as a percentage of your assets to manage your wealth. I mean, you're managing your own personal little empire, and gold is a nice way to do it because it sits away from a lot of what's going on right now. And it's rare that you say like, oh, I'm trading gold bars and coins. I mean, it's like you can do that, but I mean, you don't really do that. It's not really something you buy as a trade. We talk about in the newsletter all the time that like if you had hypothetically 5% of your money in gold, maybe, and you had like 2% of your money in Bitcoin or something, you can have like 40% of your money in stocks. I mean, you could start doing the math on this and you go back and you say that having 5% of your money in gold has been like a pretty good idea, because what it is it creates a stable base for you to take other risks. That's my opinion. And everybody thinks that I'm like sitting over here trading gold. It's not the case. I mean, I just think that it's interesting if you start thinking about yourself as an asset manager and not as a rampant speculator. The dealers are telling me that the premiums have not really gone up that much yet. There's finally been some buying. I mean, there was nothing but selling for for years, to be honest with you. Until recently, there was some buying. But I think the people that are in the options and the ETFs and the options on futures and the futures market, I think these people have more liquidity problems. Now, I will tell you that last year I did hear about a lot of people selling coins. I would get calls from dealers saying, I have a guy in here with 100 Eagles. Do you want to buy some of them and stuff like that? And I thought that was strange because we've been living in this like fake prosperity and you haven't managed to make any money. I mean, like, what are you doing? So I don't think gold, maybe they had too much gold. I mean, you can definitely have too much gold, by the way. And that's from the guy who wrote the most widely distributed book on gold there is. I'm telling you, you can have too much gold. I mean, it's like you can have too much of anything. I mean, a long life is about living with a balanced approach to existing. Most people have zero gold. Like if you take a survey, if I walk around with with the coin, it's like nobody even knows what the coin is worth. I mean, like if you're watching this video, you're in like the huge minority of people, and even people watching this video are hoping that I'll tell them to buy some sort of over-the-counter stock that can change their life. And I hate to tell you, but I'm not going to do that because I'm not involved in any of those stocks. And there have been other market times where it was good to have high-risk stocks. But this has not been one of them. Do you notice this? Like, this has not been a time to take risks. This has been a time to have cash, gold, Bitcoin. I don't care that Bitcoin was like 100,000 and now it's like 75. It doesn't matter. Like, it actually has done fairly well, to be honest with you. I mean, if you think about it, from a year ago now, it's done fine. The thing is that this has been a time to have these types of core assets, and it's not been a time to own risky assets.
Concerns over a global trade war have intensified since U.S. President Donald Trump announced reciprocal tariffs on April 2nd, sparking fears of an economic slowdown. Investors increasingly turn to safe haven assets like gold to shield their wealth as tensions escalate. China has pushed back firmly, rejecting what it described as blackmail from the United States, signaling that the trade conflict may persist for the foreseeable future. Gold, traditionally viewed as a reliable store of value during political and financial instability, has risen 15% this year. The metal's gains have been further supported by a decline in the U.S. dollar index, which makes gold more affordable for holders of other currencies and often boosts international demand. Investors are awaiting the minutes from the U.S. Federal Reserve's latest policy meeting, expected Wednesday, for further insight into potential interest rate cuts. Currently, traders are pricing about a 40% chance of a rate cut in May. In such environments, gold performs well as it offers stability in contrast to the volatility of zero-yielding assets when interest rates are low. EBTucker notes that gold has remained a resilient asset in his portfolio. While there have been past periods when high-risk stocks outperformed, he believes now is not one of those times. Instead, he advocates for holding steady assets like cash, gold, and even Bitcoin despite their fluctuations. According to Tucker, this is not a time for taking large risks. It's a time to build a strong financial foundation, and gold remains a key component of that strategy. Let's get back to the interview.
Well, let's just say that it's like a regime change. I mean, that was a certain way of managing the society. And now you have a regime that says, no, we're not going to do that. What we're going to do is we're going to advocate for this American business person and, this traditional values that people talk about all the time. And all these people pay lip service to. I like to live at the bookends of life because that's where all the passion is, right? And I love when I hear these people that are marching to fight government cuts. And if you watch, they'll interview these people and they'll say, tell us what you're upset about. Then the 401k value went down too. So it's like, okay, let me get this straight. So you want your 401k value to go up and the government to get smaller and spending to go down and taxes to go up. Let me just make sure I understand everything it is that you want. Basically, you're delusional. So most people are like this. Most people are completely clueless. And what they do is they talk about themselves as this rugged individual that it prides themselves in being able to think clearly and make their own mind up. And then they basically do whatever you tell them to do, okay? And so this regime is saying that it's going to support companies that make real things, all this different stuff. And what I think is, why don't we just listen to them and try buying that instead of the old regime? Because let me be honest with you, the last guy that was president and then the guy that was president with Bernanke, it's the same cabal, okay? That's the deal. You have like, same baseball team, different player. So don't even get started with like, there's the president's really even that involved. It's usually, there's backing of interest behind whoever's in the big house, okay? There's like, go back in history and read. Like when you read about the Dulles brothers and how like maniacal they were. They ran Sullivan and Cromwell before that, huge law firm in New York. They really took good care of their loyal clients. Okay. My point is that those clients had their ear once they were in government. So don't even think that it's like one person is making, that's why when somebody talks about somebody being senile or crazy or whatever, don't even get involved in that. There's a lot of propaganda going, trade what's happening right now. Don't even think, is it a good plan or not? Because it doesn't matter if it's a good plan. Bernanke's plan wasn't really a good plan. You were going to basically create all these distortive effects in the market. Think about it. You created Theranos. You created that girl that just got convicted of defrauding JP Morgan for over $100 million by selling a company that had just completely fraudulent user data. You created a lot of things during that 15 years that were totally bogus. And the way you did that is you had this program going on that you had levitating asset values just getting bigger and bigger to make everybody's mood stable. And so now you have clearly a group of people that's like, we're not going to do that. This weekend, all over the news, the whole cabinet was saying, think of it like a patient having surgery, okay? Like there's 50 years of bad behavior and you have to do the surgery and then have a recovery. Now, don't even for 1 second start alleging that I'm a fan of this type of thing or that type of thing. What I'm trying to tell you is that I met Besant a year ago. I listened to him talk to this small group. I listen to these people. I go talk to these people, listen to them, learn about them. I think they're interesting. It's fun. And then you start seeing how they go into the public sphere and what they do. And what I'm trying to say is don't be persuaded by like manipulative journalism that's got a ideology behind it that might not represent you very well. Instead, just say, hey, but what if they're not that crazy? I mean, what if what they're trying to do works? What do I care? What I want to do is survive and thrive in a system that wants to control me. That's what I want to do. I want to be, I want to get out of the campsite before the bear gets there. That's what I'm trying to do.
As global trade tensions rise and monetary policy remains uncertain, investors seek greater security in tangible assets. The shift in sentiment underscores a growing preference for value preservation over speculative growth, particularly amid concerns about inflation and political instability. With gold already making notable gains this year, it is increasingly being viewed as a financial anchor in portfolios aiming to weather unpredictable market conditions. Whether driven by cautious central banks or defensive investor strategies, the current landscape creates fertile ground for sustained interest in precious metals. In light of these developments, could the next market cycle redefine traditional investment strategies, favoring hard assets like gold over high-growth equities? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.